Good morning, everybody. How are y'all doing today? I forgot what the stream was on. All right, let's see. Happy birthday, Pickle Daddy. Can you cover the Chicxulub crater and what a similar impact would do to us today? Um, yeah, I guess. It happened about 66 million years ago during the KPG boundary period off of the coast of the Yucatan Peninsula in Mexico. Um, it was discovered in 1990 by Antonio Paramar Camargo and Glenn Penfield. I don't know much more about it than that. It would kill most life on Earth, but I think the existence of birds indicates that not all life would die. What's up, Chinese Spaghetti? Fuck that science shit. We need a breakdown of Friday night. That's what we're all here for. So, I left my apartment, I want to say around like 8:30ish, and I headed over to La Grande Boucherie, which is like a French restaurant bar in Midtown. I sat down at the far end of the bar, and like I'd already made a reservation, and I waited for the other person to show up. Um and then I received about like, I don't know, a little late, 45 minutes later, I receive a text that says like, "I'm here. I'm wearing a white dress." And I'm looking around, and there's only one person in a white dress in the restaurant. It's not the person, at least that I thought I was talking to. Um so that was strange. I was already a little drunk and decided that my best course of action would be to attempt to sneak out without being noticed. Unfortunately, the way the restaurant's set up and where she had seated herself, she was blocking both potential exits. And so I kind of started talking to the bartender about it because he was standing in front of me and blocking my face. And he had to move like a bunch of stuff out from behind the bar. And when he went into motion, I kind of got up and ran out to the patio. I jumped over some potted plants and made my escape. It wasn't a dude. It was just not who I was. I'm not going to say anything mean. It's just not who I was talking to. which happens in New York City. It was not good. Do you know about the Tartarian history and mud floods? Not a lot, no. Well, I was in a very awkward position because even though my Tinder profile is just my head photoshopped onto various bodies and things, like centaurs, me holding ducks in competitions, stuff like that. Um, it's still my actual head. I did text her something. I said, "Sorry, I can't make it." About 10 minutes after I escaped. I called on the pigeon whales for help, but why aren't you on Raya? Aren't you rich? Yeah, but I like to slum it, so. Sorry, Greg, I've catfished you. Thanks for your stream. Thanks, Dad. I've catfished you for the last 13 months. I'm not a pirate. Really? You son of a bitch. You need to be honest and tell her that her profile is misleading. I think she's aware of that. Like, her profile is several pictures of a like blonde girl in various Lululemon attire. That is not what she looked like. She might have been expecting a centaur. I don't know. Were you wearing your I Wyckoff t-shirt? Sorry, Reddit reader. Did you tell her to buy AMC? I didn't speak to her at all. Okay, can we get to the stocks now? That's enough of this. At least you have extra cash for this week. Yeah. How are we looking? Pretty good. At least I like the setup. I think we could still see like one more short, which seems to be, at least from a technical perspective, common before we start running up. Although we may have just already started running up. More date talk. Waiting for cash to settle so we can average down upstart 35s. Nice. Apple calls? Maybe. I played them last time. Ugh. Jesus Christ. Apple got fucking hammered. Good support, though. Psychologically, too. Yeah. Apple calls could be okay. Can you speak on M or Upstart? Yeah. What do you want to know about them? Anything specific, or do you just want me to speak on them? M looks good. Kind of found a bottom a little bit below my risk for last week, but I just averaged it down. Um, the call chain still looks pretty strong. I think negative gamma breaks down pretty rapidly. 1 second, let me stuff. There we go. Gamma max on M is, let's see, like around 2156. Delta neutral's turning up, Vega neutral's dropping, gamma neutral's rising. So that looks okay. I don't expect M to run super fucking hard. But I think it's got some decent room to the upside. There's a lot of call OI at 20, and it's even okay up to like 21. It would be cool if it'd fallen below 1650. Did it actually hit on Friday or no? Oh, it did. Yeah, okay. So the market maker hedge on it should be flipped now. Let me see something. Yeah, gamma flip positive on Friday. The skew adjusted Gex did. So that's usually a positive. We'll see how that plays out. But it looks good. I mean, it's just another Opex stock. Kind of like a cheaper way to play Opex. Upstart's kind of a different scenario. Upstart fell to my risk last week and just chopped there. Which I'm okay with. But it's what I want to see from Upstart is while it's still on Reg Show, is for it to run. It's got a pretty low float. They're a decent business and they're definitely overshorted. So if it can pull off an Opex run of any serious volume, then like a move up to previous prices is possible. It may hit like 35, it may hit like 40. But more importantly, it'll generate a lot of FTDs while on Reg Show. And that's how you get, kind of like GME 2020 setups, right? Where you get all that volume while you're on Reg Show. Because then that has to be force settled, and that starts to get really tricky when you can't actively short the stock except through like ETFs or the DMM. I saw the volatility model. The only problem I have with those is that like they're more of an indication of what is like they're very good at predicting what's happened in the past more than they are predicting what's going to happen in the future. And it only accounts for like MM volatility pricing, which since the split has changed, and so I wonder if he's factored that in. It's a cool thing. It's like something they use to train like algorithmic like trading systems, like algo trading. Um there's a few other models they use as well, and you generally like try to pick one that fits best. But there can be a lot of bias in them. I wouldn't put like a ton of faith into it. I think he even said that he's like got calls and stuff for this week. So the setup looks great. All the indicators point to a real OPEX, and we get an OPEX. What does that mean? Don't we see evidence of obligations due? We see some evidence of obligations due, but we can't figure out like how much of that evidence, like how much of what we're seeing is obligations for GME, right? We can just see like, puts closed on XRT, but we don't know, out of those puts closed, how many of them are actually, being used to mark long shares of GameStop, for instance. We only know that XRT is closing puts and clearing obligations, but we don't know where we're going to see that effect. Historically, there's been a lot of, correlation with GameStop's price movement and that happening. But as far as forward contracts go, there's no evidence of them at all. The exchange that formerly traded them no longer exists. They're still used, but they're like bespoke contracts that no one can view. I have October 21s, December monthlies, and January monthlies for Upstart. I sold puts the other day while they were still a little overpriced, and used the credit to buy calls. Did you see the spring setup I sent you yesterday? Yeah, I don't like Wyckoff on that short of a time scale, but yeah, I saw it. It was fine. Nothing wrong. You're right. It's textbook. What is VOX? Bullshit. That's what it is. It looks like the moving average of skew adjusted gamma exposure. What do you think about the statement that a 0.75 bump is priced in with the SPY and that it goes back up to 400 if it's not 100 basis points? I think, like a 0.75 hike might be adjusted for at least its immediate impact in the S&P right now. But I think it's longer term impact, and it's more importantly, its effect on like Q3 earnings is a totally different story. Right? Another 0.75 impact, while it might not immediately create a ton of turmoil in the market like a 100 BP hike would, very very near term we're likely to see, actually we may have already started seeing like large and mega caps pull back their like margin estimations moving forward, and this is only going to accelerate that, right? Like another hike is only going to accelerate that. So sure, some of the effect of it may be priced in the near term, but in the long term, no. And not even that long, right? Like next few months. Thanks. Best birthday gift ever. No problem, man. How do you weigh the pros and cons of shares versus calls? I'm not asking for specific guidance here, more general theory or considerations. It's tough, right? So you can sell covered calls or calls on leaps just as well as you can sell them on shares. I generally won't buy shares of a company unless I think it is underpriced and undervalued. If it meets both of those criteria for me, I will buy shares of the company. Otherwise, I will buy options or leaps. Mostly because, sometimes it can take a very long period of time for a company to realize that valuation in the market. And, say what you will about stock, but it doesn't decay, right? Like it doesn't have a natural built-in rate of decay, which an option always will. And so if there's something where I really think there's good potential for long-term value, I'll buy stock. Sometimes I'll also buy stock in really volatile positions, where there's a massive amount of upside potential, um, that I want exposure to, but I may be, flipping options contracts that I'm trading on it. Like Revlon, my shareholding in Revlon is mostly there to protect me from an unexpected move up where I can't chase with calls, right? So like if I've sold my calls and then it suddenly starts squeezing the next day, right? I'll still have those shares. And even if I have covered calls out on them, I can sell those shares out from underneath the covered calls and leave them naked, because obviously like price movement into that unexpected range would be very brief, right? The Juno obligations will hopefully come to light. Well, at least to some extent. Yeah, that'd be nice. Other things ran on June Opex, just not GME. And GME did a little, so it's confusing, right? It makes me feel like they rolled those obligations forward because we did run. Like I know we want to call them OPEXs and NOPEXs, but I think the only true NOPEX we've ever had was August, right? Where we had price decline in the T+2 period. Every other one, June was 20%, April was like 14%, July was 18.6%. Like that's a big move still, right? And if their intention was to break up obligations over a longer period of time in order to create like less upside price movement, then they were successful in doing that. But those were still opexes, right? Like they still ran, and you can't, as much as you want to ignore it, or maybe you didn't position well for it, or you got burned on it, that price improvement in the T+2 period is still relevant as far as like I'm concerned, or the data is concerned, right? Even if it doesn't go up 100%. Yeah, I'm gonna over time. I'm working with someone right now to do more videos on that. We're trying to figure out like a format and everything, and then I'll start churning out more videos over there. Thoughts on EVGA stopping production of NVIDIA GPUs? I feel like that's not good news for NVIDIA. Isn't EVGA like one of their largest aftermarket manufacturers? Why break up cycles from more runs and less price action when they make money off of volatility? I mean, but they hit a lot of illiquidity there, right? So, there were things that happened in the early part of this year that created a lot of risk for volatility shorts, right? Like borrow rates skyrocketed. If we think about like the post March run period, right? Borrow rate was still very high. Very, very high, right? It was like didn't it hit like 100% or something? Borrow rate was high. Liquidity was low. And if they ran it, in May, for instance, right? Say the May obligations were really a problem for them. And if they ran it in May as hard as they had in March, maybe it would have triggered a squeeze, given that the borrow rate was already significantly higher than it was in March at the time, right? And liquidity in ETFs, with XRT still on threshold, and just about, maxed out all of the borrowable shares everywhere, which is why we saw borrow rate rising, right? If it had run that hard again, it's very possible that, they would have been in a situation where they got squeezed out, right? And so by, taking the May run and breaking it up over, several periods into August through June, July, they were able to get the borrow rate back into, a tractable range. And even now, it's still quite high, right? Remember, we spent most of last year at 0.75%, and our current borrow rate's like 10.3. And we talked a lot in the past about how borrow rates above 10% are relevant. It's still relevant. And this is the first time we've really seen them be able to drop the price significantly, right? Here in this August period. Which means they're likely, given all the shorting they've done to get us to the price we're at now, loaded up with obligations that they need to clear again. And they need another liquidity event, which is what Opex does. If you guys read the When the River Runs Dry DD, these Opex events are how they get their liquidity. And if May didn't generate sufficient liquidity, then, they need to keep pushing the price up until people sell, right? In order to get enough liquidity for them to drop the price. Do we have an algo trading channel on Discord? Maybe there are others interested besides me. I'm gonna be pretty blunt. I don't think any of you guys have enough money to successfully develop algorithmic trading strategies. At least not ones that make really good money. What would that mean if this turns out to be a Opex? Cycles are broken? Not necessarily. It would just mean that they have sufficient liquidity and low enough obligations to carry forward. They are shorting volatility right now. But, for all intents and purposes, from the split on, it appears that they just walked away. Like, if you look at GME volatility through that period, GME price action through that period, there was no shorting occurring. Not even the split, before the split, when they announced the fucking split, right? All the way back from when they changed the corporate charter on, like when they officially changed the corporate charter to ready the stock for a split. From that point on, almost no aggressive shorting of GameStop occurred. And without aggressive shorting, there's no Opex cycles. But if GameStop builds up volatility again, volatility shorts are going to come back. They're never going to fully walk away. It's just they'll either be there or they won't. based on the volatility of the underlying and the illiquidity of the underlying. Remember, they like these stocks that are high volatility, low liquidity because it's very easy to spike the volatility on them, and it's also very easy to drop the volatility on them. It doesn't take a lot of capital to manipulate the volatility of the underlying stock. Which actually lends more credence to the idea that all of the last year was volatility shorts. They got caught with their pants down in January, and there's never been a short squeeze or like a consistent underwater short position. So if we don't care for DRS, the fact that it locks up liquidity is good for us. It doesn't drive illiquidity. It drives volatility. So it's good for us because we trade the volatility of GME. And it's good for the hedge funds that short GME's volatility because it makes it cheaper for them to manipulate the stock. What does shorting volatility mean? Generally selling it. When you short volatility, you're taking on the risk of higher volatility by reducing the cost of risk in the market. Whatever, not market wide specifically, just like GameStop is a market within a market within a market, right? It's not bad. It's nothing to us. Like, it's not relevant. Can you speak to how you're hedging the possibility obligations due to the split cause the price to keep climbing post Opex in terms of covered calls? What is the time frame for this possibility? You know, when we cross Gamma Max and we've hit peaks, I'm going to sell covered calls into those peaks. If the price of the underlying keeps going up and there's no reversal, I'll buy the covered calls back at a loss. I mean, that's the best you can do. Obviously, yeah, the price could keep climbing. We can break Gamma Max multiple days in a row if FOMO builds up. You know, there's other, it's not just like you break Gamma Max and it's all over. It usually is because retail can't really afford to buy calls beyond that, and interest breaks down, right? But you know, if interest were moving the other way and FOMO were coming in, and you know, the momentum of interest keeps picking up, then yeah, that's a situation that you need to be prepared for. One way you can do that after the fact is you can buy out of the money calls above your strike. You can use the profits from those calls to buy back your calls, you know, because those out of the money calls have more extrinsic value if the price is going to keep rising. Also, you can use the money from your calls getting assigned to exercise the further out of the money calls that you bought. It's not great, but it protects a large amount of, you know, your position. You know, so if you sell, let me try to use an example here. If you sell a, first, too thick. So say you sell a 35C, right? On a peak, and the price drops to like 33, and you're kind of waiting for it to go down. And then the price spikes back up to like 36. You can buy, and say this is like the 930. Let's give an expiration to this. So 35C for 930. And the price spikes back up to 36, right? You can buy, you know, $40 calls for, you know, let's say October 21st, right? And then, you know, the price keeps going up against your covered calls. They're no longer safe. They're deep in the money. You can't afford to buy them back. But with these 40Cs, you know, now these are going up with the rising price, and you buy them in an equivalent amount, 1-to-1. And when these get exercised, or like your shares get called away, you'll get that money, that, you know, $3,500, $3,500 per contract, and then you can use that to exercise these $40 contracts. So sure, you're gonna lose $5 a share, but you'll get a lot of your shares back. That's what's so great about options, is most bad situations you find yourself in, you can protect yourself from. It just costs money to do it. Will GME rise back to 40-60 when the market returns to bullish territory? That's possible. Bipolar bear in a bull market, I can see that. No, odorous colon. You're gonna have to go back and watch me at 2x speed. Is it possible there are obligations that have been consistently kicked down the road through the whole GME saga? Seems to be one of Superstock's premise for staying in so long. I really don't think so. I mean, all the evidence points to Opexes clearing out all of the current standing obligations before more are built, right? And that's why we have that cycle of high FTDs to low FTDs. You know, we get these high FTDs and then we get Opex. Or, sorry, it's backwards. We get these high FTDs and then, you know, Opex blows them all off. And then, you know, but the volume from Opex, you know, this is the price. The volume from Opex then generates more high FTDs out here, right? But it does appear that these events, these Opex events, you know, they do clear out all of the current standing obligations. They kind of start from scratch and then do it all over again, right? Because once they've spiked volatility, now they need to get it down. And in order to do that, because GME is illiquid, they have to use synthetic shares, right? Which then creates FTDs and obligations. How do you sell CCs fast enough if there's a flash crash in price like back in June? You can't. I know what you're talking about. You can start selling them as you see volatility ticking down. The same way I sold out of my long position. You know, I told everyone like, hey, volatility is dropping rapidly, right? And then started selling out of my position really quickly. At that same time, you can try to nail covered call targets. That's difficult, don't get me wrong. Wouldn't another safe way to catch the peak with covered calls is to wait for the T+2 second peak? That's what I do, right? So yeah, I don't sell calls on the first one. I generally sell calls on the second one. So in March, I sold my covered calls here. In May, I sold covered calls here. And like on August, well, actually, I didn't expect the August 16th run, so the covered calls I sold on GME for August, I sold on the 8th. On the ETF FTD period, and they were expired before this run came up. I sold them much shorter term because this wasn't an Opex, right? This was ETF FTDs, and then this was like blowing off obligations because the basket was running. Which is really, really similar to the price action we saw in November. And that does concern me for next week. But I'll get into that in a second. Yeah, so the second peak of price action is best, but you have to make sure that you've confirmed this high volume event. If that high volume event exists, then yeah, there'll be a second peak. Also, the market maker needs to remain net positive gamma after the first break of gamma max. What are the white dotted lines on your chart? Just trend lines. What's up, Harry Balls? May was weird because the second peak was like 6 trading days later. I don't think it was. There was 3. Right? We had the first peak, and then volumetrically, this T plus 2 peak was higher. Then we had another T plus 2 and another T plus 2. It stayed in a higher range, if that's what you're talking about, which was tricky. But I don't think it broke gamma max until like here on the 31st. This was also you're kind of looking at 2 separate things, right? Let me zoom in here. So this is the Opex, and then this was the T plus 2, and then this is ETF FTDs for early June, like where I have the red line. So these weren't the same event. These were separate events. So this is, peak and then T plus 2 peak, right? And then this is ETF FTDs. And then this is, June OPEX, which obviously sucked. But, we still had that like Friday high after the initial like 20% run. So there was that's what's weird about June is there was an OPEX here, but it's so fucking insignificant, right? Like this is Friday or Thursday, and then Friday we ran straight up into Monday, and then the end of that T plus 2 period is that Monday? Hold on, let me make sure I have this right. I think this is Monday. No, 17. It's hard on the 1 hour chart. So okay, so this is Monday, and this was Tuesday, Wednesday, Thursday, Friday. Okay, so it was Thursday we saw the second peak, but that's because the run happened on Monday, right? Yeah, so Monday T plus 2 is Thursday. That's right. So this was the T plus 2 peak, which is where, covered calls should have been sold. The problem is, we went into Wednesday expecting more upside because this was so little volume, right? So it's more about playing the OPEX and, these variabilities in it than the OPEX like not occurring. Yeah, you can see the similarities in November with August. They're very strong. And that's a little concerning because that would make, this like a December equivalent coming up. And if we go back to that period, you know, December had a big drop and then kind of climbed up. And then we saw, you know, a bunch more price action on January 7th, right? When XRT went onto threshold again. But this time, XRT didn't go on threshold on Friday. So that might be the most bullish data point to consider right now, is that XRT is still off of the threshold list into the forward expiration period or futures expiration. If there's a split obligation similar to Tesla and Nvidia, is the price just going to continue to go up the same way as those stocks? Yeah, it's possible. You know, another really good way to handle that is when you sell your covered calls, don't sell your long calls first. I wouldn't recommend this to somebody who's like got like 100 or 200 shares, right? Because like it's just not really relevant for you. No offense, it's just not. But if you're selling a lot of contracts, like 10 to 100 contracts, this is something to consider. Your long calls can act as a hedge against continued upside for your short calls. So, you know, like I have like 32 through 50 Cs right now. And, you know, if the price moves up to like 45, I can sell, you know, 30s and they're protected by my $32 long calls. Do you have any Opex, NoPex odds? No, not really. You know, previously Opex has hit 100% of the time until this year. And it wasn't until this year that we started to see them have more of like a distributive effect across multiple months. You know, last year it was just F-Man. 100% of the time we hit massive price gains on F-Man. You know, this year it's been March, May, a little bit June, a little bit July, a little bit August, right? So it's not that, you know, it almost always something happens for Opex, with August being the only exception since, you know, 2020. The real question is like, how much are we going to go up? And the biggest problem is that you have to have exposure, because the risk reward ratio is enormous, right? You know, weekly contracts on GME, even on a 20% run, can 12x, right? That's why we play them. It's because the risk reward is insane. You can turn, you know, if you hit a run and time it right, you can turn $10,000 into like 200 grand. You could turn it into fucking a million. Like it's crazy. And so, you know, even if you're taking like a $1,500 hit every month, you know, hopefully your CCs can, you know, make back those losses. But when it does hit, holy fuck. I mean, like, just the sheer, even selling, like in March I was really conservative. You know, I sold half my position at the test of Gamma Max. I sold, you know, the rest of the other half of my position as it kept moving up. And I sold my cover calls at the top. But, you know, I netted like fucking 1,700%, 1,800%. And that was conservative. Like I didn't even hit the peaks. I didn't buy any fucking weeklies. I reduced my position size by half, rolling it out. There's too much bullishness. I can't deal with this. I mean, there's a reason we play them, right? There's a reason we're all still here doing this after Freg's Day and after, because when it does hit, holy fuck, right? Like BBBY or better than BBBY. One GME Opex beats the BBBY run. And we get them a little bit almost every month, with the exception of 1 month in the last 2 years. I mean, you still don't want to risk more than you can afford. You want to take every precaution you can. You want to buy farther dated calls and have, as little theta exposure to near-term price action as you can. And then, you want to be able to cut those losses quickly. August OPEX didn't happen, and a lot of people just held on to their contracts waiting, and you should have just cut. T+2, nothing happens, cut it. Even if it does run and you miss it, get the next one, right? Every month into the split. And, some of that is now backed by market fluctuations because of being in a bear market. Now the SPY is moving into OPEX cycles because there's so many shorts on the SPY, right? And like SPX that we're seeing it move into the same OPEX cycles as these fucking meme stocks. So, SPY had all of the same setup parameters that we looked for on GME on Friday. And when the market became its most illiquid, it became its most illiquid everywhere. It wasn't just on, GME. It was on BBBY. It was on APRN and beyond, and all these other stocks. They all just started squeezing at the same time because liquidity was gone everywhere. And that's what happens when the bears have overcrowded all the sources of liquidity. And there's no bulls, right? You can only eventually you're going to hit seller exhaustion. They're going to take profits, and that liquidity is all going to flood back in. Because now those shorts have become buyers. Speaking of SPY, pretty much nothing but bounce around until Fed stuff on Wednesday. Not necessarily. I think we'll probably see SPY continue its bullish reversal into the early part of this week. I do think we'll stabilize in a range before the Fed meeting on Wednesday, but it could be in this upper range. Like the SPY may keep moving up Monday into kind of this. You see, I don't know if you guys can see this, but there's like a little range here. I could see us bouncing up into that by Tuesday, chopping. That 395 level is pretty important. There's a possibility we move up to like 400, but I think 395 is more likely. There's a lot of really strong support in this range. Call side is pretty strong here. So, I think with puts selling off, puts that were in this range selling off, we're very likely to see, a bounce back at least to here. And then it'll probably stagnate there until the Fed meeting. And then if the Fed moves forward with 75 BPS, I can see us moving higher. If the Fed moves forward with, 100 BPS, we'll drop, right? they may not have any obligations for the split, right? I mean, if what's going on GME is truly only short volatility positions manipulating the stock because retail buys and holds, and it gives them an opportunity to make money off of volatility, right? Then they can come in and walk away at any time. There's nothing tying them to the stock or forcing them to be here, Bob. So if that's the case, then I would say, what obligations? Like, what long-term obligations? What if there are no obligations for the split, right? What if it's just simply short vol like all these other stocks? GME isn't special at all. It's just the same as the rest of them. The only difference being retail's very specific participation in GameStop. I know that sounds bearish, but if you think of it, as a way to make money, it's insanely bullish. There's no way for us to see if forwards are due, Yaga. There's like single stock futures and forward contracts. There's no true evidence of them existing. If they do exist, there's no way for us to track them. But they do. I mean, well, they do exist, but there's no way for us to track them or to know if they're being utilized on GameStop. We have some evidence that they are, right? Because we can look at, fund flow from XRT, and there's only so many ways to hide the shares, and through the process of elimination it leaves us with forward contracts, but there's no way to track them. There's no way to see, like, oh, X number of shares are due in this contract for GME by this date, right? And then something I was, gonna talk about, I guess I can talk about it a little bit here, I'm digging into right now, is the potential for forwards to be written against GameStop and then performance swapped with more liquid assets. Not only GameStop, but like this really came up with Revlon, because there's some evidence, that there's swaps in place with Revlon and these other really illiquid basket stocks. And, as we know, Revlon's not in any ETFs officially. And so they need to get liquidity from somewhere. And so we're kind of trying to investigate, or at least I am. I'm investigating the idea that they could be writing forwards against more liquid assets and then performance swapping them, forcing other participants to be the buyers of GameStop on their behalf. There should at least be obligations for the ETFs from the split, right? It's not a guarantee. That's, a theory. It's a theory backed by some loose correlation with older split dividend price action, like Tesla, Nvidia, a few others that we looked at. I can't remember the names of them right now, but split dividends aren't very common. There seems to be a high occurrence of these, Opex runs after their splits, which would indicate, given the time period of the run, that ETFs are, have obligations due for the underlying stock. But we don't know if that's the case or not yet. If we run far beyond gamma max, then we have some indication that, yeah, that's true. but I've said it a bunch. That is a theory, right? Like it is a very speculative theory. An Opex this month would be life changing for me due to a family emergency. But if it doesn't happen this month, there's always next month. Yeah. I mean, if you time them right and your options timing is really good, most of the time you will be up 50-60% before Opex ever even happens, you know? We talked about a lot of stuff. What's your point of view on Mason Capital loading up GME? Over 2,300% increase? Jesus fucking Christ. Do people not understand percent increase versus like number of shares bought? They only bought like 500,000 shares. You know, there was some other fucking fund that bought 1,200 shares and their holding increased by 63,000%. That's just a meaningless way of like defining a number in order to, provide confirmation bias and hopium. They didn't buy that many shares. It was a little position. Jimmy has a free float of like 256 million shares now. 500,000 is nothing. It's like, yeah. I don't even understand how that trended. Like, it's shocking to me that many people do not understand what a percentage increase means. Are volume oscillators useful for intraday trading? You discuss how you track volume for OPEX runs. I mean, I just look for the biggest indicator of it, like a true OPEX run, is volume significantly in excess of the like 3-month rolling average, like 4 to 5 times the amount of volume. You don't really need to track it. It's super fucking obvious. How is this shocking? Most people are not analytical. But I mean, like, the number of shares they bought is right there in the same fucking report. Like, you've got to, like, look at that and be like, oh, like, yeah, of course it went up 2,300% because they had, like, 5 fucking shares and they bought 100, 500,000. Like, it's just, like, not, you don't look at the fucking shares? Like, how many like, physical shares they bought? Like, that's just one step further in looking. What do you think? If you think funds are listening to financial media, I got some news for you. They're writing it, but they're not. They're not listening to it. Are we at all worried that split has resulted in such increased liquidity that these OPEC cycles might not be possible anymore? No, GM is still very illiquid. Splits don't inherently increase liquidity. Liquidity is the same. Um, it's the psychology of the participants after a split that increase liquidity post split. I think people do understand. They just choose to highlight the percentage to hype others so they can keep the hopium party going. Yeah, super stonk lying to super stonk, proving themselves to be the largest shills. They themselves have done more damage to the community. The community itself has done more damage to the community than anyone ever could have hoped by paying off somebody else. You timed the Opex, you timed the bottom perfectly. I'm not sure how to do that myself. Was it a support line? I mean, I waited for negative gamma to flip, and then I waited for put suppression in order to crush IV, and then I bought when IV was at its low point for the cycle, or a low point that I found attractive. Obviously, I'm sure even where I bought there were better entries, but mine was very, very good this time around. That's all you're really waiting for, is you're waiting for IV to bottom out, right? People focus too much on price. Like, everyone's sitting around waiting for, $22.50 or $20 instead of just, buying the low IV. There was an opportunity on GME back here too, to buy even lower. And if you'd bought really, you have to buy really far dated calls because there's so many days in between this period and Opex. But yeah, I mean, this period was insane too. IV was super low, price was super low. I waited because I wanted more confirmation, more evidence that we were going to have an Opex before I bought into a larger position. But this was another really good entry opportunity as well. And there's a few people that bought during that time frame. And the cool thing about nailing this one is that even if there's a NOPEX, you're up massively, right? Not only are you up in price, but you're up in volatility as well. So usually I'll buy both. This time I wanted to wait, though. Even now, there's still great buying opportunities. Yeah. I mean, you can buy all the way into when the run starts. Is there a better way to view options OI than clicking through individual strikes? Is there a website you use? Market Chameleon, I think, has some of the data for free. I would say, however, that I would not pay for Market Chameleon ever. The rest of the data they provide is kind of inaccurate. Like that, that options flow data where they track net delta throughout the day is usually kind of wrong. And that's the thing most people buy it for. But their OI data is good, and they let you download CSVs. So, for someone compiling a lot of data, it can be useful. Otherwise, I would never pay for their service. It's ridiculously overpriced and not worth it for delayed data. As a matter of fact, most free data or paid data is garbage, right? If they had really good data, they would just use it to make money. They wouldn't sell it to you. So they sell the bad data off. They use the money you give them to pay for good data, and they use that data to make money. So just, if you want that data, just cycle free trials or some shit. You looking to get into any other plays this week, or just manage the handful already playing? I mean, I'm gonna provide my thoughts tonight on SPY. I'm gonna throw up a couple more things that I think have some potential going into these next couple weeks, but for the most part, my focus is going to be on the stuff from last week. Obviously, a lot of my positioning into Opex periods is done the week before, and then this week is managing the position. So expect Pickle's picks to be a little lighter tonight. I'm gonna do my macro overview and all of that. But and there are a couple more things that I'm looking at or that I want to highlight, but not a lot, like 3 or 4 stocks right now that I'm kind of dabbling with. And I still need to wait for futures to open because with all the earthquakes and shit over the weekend, there could be some negative sentiment. No, interestingly, and something I was hoping on is that post split we would see far more options trading, far more trading on GME, right? More volatility. And we've seen less actually. So yeah, the split didn't really provide. I mean, it doesn't always, but usually splits make stocks more tradable, which helps improve their valuation over time. And we saw it a little bit in the period after the split, but it's died down a lot now. You know, retail interest in options and GME itself has lowered, except in the fact that it's cheaper. So has institutional interest, but that has more to do with market conditions, like prevailing market conditions, than anything else. I bought once the trend started last time and still made a 7-bagger easily. Yeah. Did you buy weeklies or 1 week out for Opex if buying tomorrow? Or does the little extra theta not really matter since it'll most likely be over by Wednesday end of day? Um, yeah, if I'm buying tomorrow or Tuesday morning, I'm probably buying weeklies. I have plenty of far dated calls right now, so I'm not, you know, I'm in most of my farther dated OPEX position. Everything else I buy will be more speculative and probably a little more chasey. Weren't there like a shitload of earthquakes over the weekend? And there's like been a bunch of news about Taiwan. Maybe I'm just imagining things because I haven't gotten any sleep. But I thought there was like a big earthquake. Yeah, off the coast of Taiwan. There's been like several, right? Yeah. Okay, I'm not crazy. That's not good. Not really. What's your current thoughts on possible price target max for this OPEX right now? I mean, there's no way to determine the max, right? Because the max is determined by FOMO. It is, right? You know, FOMO drives up gamma max at intraday. Um, but right now, gamma max on GME is 35, right? And then, you know, 10 to 15% of that. So 350 or 525, $5, $3.50 to $5.25 more. When do you expect a massive leg down on the SPY due to the impact of higher rates? I feel like I've been covering this question like a lot. Higher rates, corpse adjusting earnings projections, and macro environment, etc. How are you thinking about entering SPY positions with FOMC? I'll probably initially straddle FOMC because obviously we don't know what's going to be said, but maybe I will short side favor it. As far as like a longer term projection, I think we're going to start to see guidance getting pulled back and margins reduced in like the mega caps and large caps into Q3 earnings and Q4. I think that's where we're going to see the most effect from that. So if I had to pin you know, a market crash into a time period or a massive downturn in the indexes, I would say into the end of this year seems most likely, provided that the Fed's not overly aggressive this coming week. Did you give a possible explanation why Tootsie Roll is so resistant to the volatile market? Um, they just like sell candy. They'll always sell candy. They don't have a lot of shares. They don't have a lot of ETF exposure or active fund exposure. You know, most of the company's insider owned. Uh, Depression, recession, boom, or bust. They kind of just do the same shit year after year after year at a very, very slow rate of growth. Some companies just aren't that interesting, right? Yeah, watch for severe IV crash. That's generally a good thing to watch for. Usually at a point of resistance. The last time that happened, we crossed gamma max, and then you know the price fell, stabilized, and then IV started tanking. You know, watch your contracts. That'll be your best indication. If you have stops set on your contracts, the IV crush will start triggering them. Is there a time frame over which a Tesla like post split OPEX increase might occur on Jimmy if it occurs? Was that a T+2 event or was it longer? It was longer. But you know, a lot of that could have also just been the fact that the market was running like crazy and Tesla was by far the most popular stock to buy, right? So there's a lot more outside of that beyond just the covering, right? If you look at the volume trends through that period, through Tesla's split, you'll see that most of the volume, or like a big chunk of the volume that occurred post split. Hold on, let me go out to like the 4 hour. In that post split run up, like a lot of the volume that occurred here and here. So it was November and December OPEX periods. You know, what they probably try to do is cover, and probably tried to do on Tesla, is they covered some of the outstanding obligations, wrote forwards for the ones they couldn't cover, and then covered those here. Right. So, you know, the dam kind of breaks, they cover what they can. Then simultaneously try to write out as many of those obligations into the future, which we see here, as they can, and then cover the rest later, right? Anytime they can diffuse price action or split it up, they'll attempt to. I'm squeezing every drop out of my Dillionaire subscription now. Awesome, man. Any chance, did you mention what the Bobby charts you sent meant? The ones on Discord? Those are just like the nave, like the gamma and the hold on, let me look. I'm trying to remember what I sent. I sent the gamma for all expirations by strike, the skew adjusted gamma for all expirations by strike, and the call skew. Call skew fell off, which means that, you know, call interest was dropping into Friday. The skew adjusted gamma, a lot of that expiration is on 10/21. So there's still a lot of negative gamma resistance to upside moves on BBBY. And then the gamma for all expirations, I was kind of highlighting that gamma dies off really hard after the $15 strike. So if it moves, which it may not, it probably doesn't have the potential to move a lot. Even during a run, weekly shouldn't be held no more than a coup. I mean, if they go in the money, you can hold them, but otherwise, no. No, you shouldn't be holding weeklies for extended periods of time. Unless you're gonna like average them down, or like, you know, after Tuesday, so Monday and Tuesday, weeklies bought for that Friday start to become very, very, very risky, right? Because Theta starts decaying so fast into like Wednesday, and Wednesday, Thursday, Friday. So generally, like weeklies bought on Monday and Tuesday are held for Monday and Tuesday, or Tuesday, Wednesday, Wednesday, Thursday, and then Fridays should kind of be by themselves, like zero DTEs. If they go in the money, theta decay on them slows down and they're much safer. But the biggest difference this month is the net negative gamma and delta hedges, which we didn't have going into June. We didn't have that going into July, and we didn't have that going into August. So we actually have like a large amount of puts ready to be shed to catalyze upside price movement. So that's the biggest difference, and it's a very important one. So 90, it's not 90 days after the split. There's no set time period. It depends on when the split occurs and when any future forward obligations are due. But there's no like, you can't just be like, oh, it's 90 days. It's not. It just depends on the timing. Forwards for ETFs can be written to the following quarter. Which, you know, in this case of Tesla's split, was November, December. In the case of GME's split, you know, Tesla split on August 31st. GME split in June. So the next available quarterly forward contract period would be September. Whereas for Tesla, it was December. He said that seller stores will have a lot of inventory and they will sell it because they don't want to hold it. And when will they put it on discount? They've already started, actually. If you go shopping, you'll notice that a lot of things are heavily discounted. That's why Amazon had like the additional Prime Day. Black Friday is going to be probably huge this year. Like Walmart, Target, all of them, they're going to be shedding huge amounts of inventory for Black Friday. So pay attention to that. Cyber Monday. Any chance to discount and offload large amounts of inventory will be taken advantage of, especially into the holiday season. They're on GME directly. They bought shitloads of puts, and specifically when we were going to break uh, net negative gamma last week, like at the point we were gonna break, they would buy huge amounts of puts in order to stabilize GME in the net negative gamma range, right? Because they want the market maker selling into their downward price action and stabilizing volatility. Because if the market maker's hedge flips, the market maker is going to start hedging to the upside, right? And that's going to drive upside price action violently. So there was a lot of effort this last week, which we haven't really seen since May or March, to keep the market maker hedge negative. And that's something that strongly indicates the potential for Opex covering, but also skews things like the Garch model, because they're suppressing IV intentionally, which on a probability model like that would skew the result of its prediction. Seven months? What the fuck? That's longer than my typical relationship. It's 11, Dr. Fart Sniffer. Together forever. Lots of put closing on the SPY. I expect the SPY will continue to rise into tomorrow morning and the rest of this week, provided that the news over the weekend isn't too negative. Even if it is, it may not be able to stop the momentum at this point. Well, I guess that's it. Is everyone ready? Was there anything you guys wanted me to cover before I wrap it up today? I think I've covered everything. Thanks, Starscream. Appreciate it. No, I'm not gonna do it all again, Gwibora. You can just rewatch it, The video's here for eternity. I don't always ignore you. I know I did good because no one said anything, right? Like everyone was just too interested to ask more questions. So that's usually a good sign that I'm on one. How do I get out of ACIW? I don't know. I just assumed you were fucked. Take your losses like a man. No, hold on. I'll take a look for you. Jesus fuck. What a piece of shit. Wait. I might just wait. At least if the market rallies, you might get a chance to get out. Earnings are better. You got earnings coming up. Maybe they have like a surprise beat. Like a good surprise. Looked like that triggered a bit of a run here in June. I mean, you can't be that fucking underwater, right? Or you just have like short dated calls and you're screwed. Do you have revised entry and exit targets? Do you have revised entry targets for M? I don't think so. They're kind of just the same. I mean, it slipped like a tiny bit below my risk line, but you got to remember that when I draw these risk lines, you have to adjust them based on your own risk and um, like your own determination of the potential for the thesis, right? Like, so, you know, I had risk set. Wait, hold on. So I had risk set at 17, right? And it's slipped below like the first day. If you bought in, if you bought in on like I think day one, then you know there's probably a good chance to reposition. But when it hits that, you have to determine if you're going to sell or you know you're going to average down and lower your risk. You have to look at the trend. Like there's stability not far off at like 1650. You know there's another layer of support here down at like 1614. So you know you have to reassess, but that doesn't mean like the play's dead over. It's just, you know, a point at which you have to reassess your positioning. It had a nice bounce back on Friday, right? I thought it did okay. I just bought more calls when they dropped by 50%. Don't ever enter all of your positions at once either. Remember? You know, buy some early, but then also, you know, save some money to confirm later or hedge downside or offset risk. Yeah, I'm still bullish on Revlon. What was your question, King David Cartel? You could just ask it again. If you didn't tag me in it, I might have missed it. Why are people so worried about your risks? Pickles picks are for educational purposes and paper accounts. I know. Hey man, did high negative delta exist going into the past Opexes after they blew off some steam earlier in the respective months? Yes. Except November. November had positive net gamma. I don't know about the delta in November, but I know that the net gamma was positive going into the run, which is one of the reasons the run was so shitty, because it was just all obligation backed with no push from the MM. Remember, we ran like $20 on the Friday before Opex in November on my birthday. That was a good birthday. The follow up was terrible, but Picklespix, you got to link your Discord to your YouTube account, Teaspoon, and then that'll open up the Dillionaires channels on the Discord, and then Pickles Picks are in the announcements channel there. Friends are interested in HT with similar reasoning to Rev. Can you give a quick opinion? If it's like Rev, probably not. It's got a much larger float than Revlon. Um, I would say from a technical, like on the technicals alone, it looks decent. It looks like their earnings are picking up some steam. Um, this is a REIT. You know, not likely to like squeeze, but interesting. Quite cheap. I would imagine that they got hit kind of hard because of the pandemic. I would probably want to look into their financials and check out some of the what's going on with like, you know, their assets, how much cash they have on hand. Um, Try to make a determination on how well they can weather a recession. Especially after getting hammered so hard during the like pandemic period, because this was disastrous for them. I was thinking of entering longer dated spy puts if we get back to the 400 405 range. Do you see 415 being possible? Yeah, it's possible. Seems that it's the outer range of an irrational move. Do you think that range makes sense? Yeah, I do. 413, 415, 410, all very strong upside resistances. I would pay attention to all of them or average across all of them. AMD calls 18 November 90C. Too far out of the money. What's your thoughts on V at this price target since it's fallen below? I have calls on V that I bought sub 200 already. It just hit resistance. This is good. A market rally will drag it up. Obviously, you know, I'll have to adjust like risk and mid. But 206 looks good. V generally moves between the same risk and reward levels. Let's see, it's trading down here right now. Yeah, I mean, 200s look really nice. Sorry, I just missed a Kofi here. When chasing an Opex round with weeklies, do you buy near the money or further out of the money? It depends on how much it's already run and how much room. Usually, like, I'll buy weeklies just below or at Gamma Max, especially if I start to see big volume. You look at Jimmy October 20th, $60 call. Does it look promising? October 21st? I don't have that open right now, but I could take a look at it. It's really far out of the money. Like it's a volatility play with some delta sensitivity. Like it's got 0.9 delta, 0.09 delta. Vega's okay on it. If price moves up hard, there'll be a period where the price of that contract moves up rapidly. I would probably not want to hold it for too much longer than that. But it looks okay. I would prefer something either more delta sensitive or more delta insensitive. But it's all right. Like I have 50s for the same date. They're a little more delta sensitive. They also have a slight chance of going in the money. Very slight, but slight all the same. I don't know. 60 is kind of far. We probably won't see those go in the money unless something really unexpected happens. When mega caps start to pull back on guidance and GME doesn't, could FOMO trigger something insane? It's not really FOMO that we're going to see at that point, but we'll see a lot of accumulation in smaller and mid cap companies as they're more efficient and more able to exploit smaller marketplaces. Right? You know, that's the bad thing about companies like Microsoft and Google and Amazon, Nvidia, Intel. They're you know, slow, right? They can't react quickly. Whereas, you know, smaller, efficient, debt-free companies like GME can react very rapidly to changing market conditions. They're insulated against, you know, if they have low debt, they're insulated against the rising rates. Depending on, you know, if they're manufacturing or retail or you know, tech, they can benefit a lot from the reduction in margin from these larger companies by expanding their own. So you know, that's why I said in you know, soon we'll start to see like IWM maybe outperforming like S&P because those companies are better suited to deal with tougher economic conditions. I'm trying to think of a way to say this without getting too much into the technicals. I think that encapsulates. Yeah, that's good. Rivien 35p in October. Can you tell if it's a double top or more uptrend? Friday had big volume. Second top had less volume than the first. I didn't finish reading yet. I don't know, man. Rivien's got some really, really strong buy pressure on it in these ranges. Like, if we see a big dip in the market, the 35p might be okay, but I'd be careful shorting that stock. Um, I got out like on my last play of it by like the skin of my teeth. It looks like it's peaked, and double topped here. But I could see it easily climbing higher. I mean, when this IPO'd, like it hit like 180, and traded quite a lot of volume in like the 116 range. So, and at 65 as well. So I would be cautious in these lower ranges going like long short on it. Don't get me wrong, if this trend collapses, there's a really nice downside here, but you may want more theta to capture it just because, there's so many buyers on it. Eventually, someone's going to pick up some of the interest that Tesla once had, right? And it looks like Rivian's maybe best positioned to do that. They will get competition, right? And then that market cap, is going to split across more tickers. So I'm very torn between going short on it and a big market decline pulling its price down again, and maybe going long on it because these prices aren't half bad. If one had long dated cover calls, why? I've got to ask anytime someone wants to sell a long dated cover call, why would you ever want them? And they wanted to make various rolls to get out of them quicker at least expense. Is there a way to do that? Taking advantage of volatile delta, theta, and IV. You'd want to probably try to wait for a big drop in price. P shorts, a couple weeks ago would have been an ideal exit opportunity. Volatility and delta aren't going to change too much. Like, volatility is not going to change too much on them, so you really need a big drop in their intrinsic value in order to get out. Just a note for everyone on volatile stocks, you really don't want to sell anything longer than like 14, maybe in some rare cases 30 days. It's better to sell quickly, rapidly decaying theta than it is to sell long-term theta. It's still like EPAM to get down into the 350, 375 range. Yeah. Just as long as you have time, there's still that fat gap, and it's just starting to brush up against it. So this may rally a little bit here, away from the gap with bullish sentiment in the early part of this week. But I still think there's a really good chance to fill that range down to 375. 350 is the bottom end of that price target. Obviously, like EPAM gaps a lot, so if it falls hard and hits this range, it's likely to fall a little harder before recovering. So watch it. Make sure you have plenty of theta. If you need to, roll forward. It's a big enough move that it's worth extending the position on. And yeah, if Nasdaq drops, EPAM will come down with it. Remember, it's very illiquid, so it's more sensitive to big moves like that, and you'll get more price fluctuation on a drop. It's already down quite a lot from the peak where I first started shorting it up here. So I think people need to be clear though that Rivien is just a trade. I mean, I'm not even trading it. From fundamental standpoint, it makes no sense, right? Not yet. Like its fundamentals are kind of shitty right now, but they have a lot of backing and there's a lot of interest in their stock. You know, high equity value means that they can generate revenue, and generating revenue is the first step to becoming a successful company and pushing growth. Oh, sorry, equity, not revenue. Equity. If they can say enough bullish shit about their stock and people are going to value their stock higher, then they can sell stock and get capital. All right, no worries. It happens. Everyone makes mistakes. Not a big deal, but yeah, you're going to want the price real low to get out of them. Good entry into Cat. Not terrible. I expect Cat will bounce back some this week. But be careful of like the macro conditions on this. You know, although I expect Cat to do quite well into its quarter 3 and quarter 4 earnings because of the way they generate their revenue, it's kind of unaffected a bit by like the macro conditions that are likely to affect other large cap companies. Um, I still think that it will see lower lows this year than it's at right now. But yeah, this is a great entry. Great entry for like the 180 and like 180 250 strikes. Just don't expect it to go up to like 200, you know. Stay near the money. Don't take a lot of risk on it. Get a sufficient amount of theta. Try not to buy weeklies, that kind of stuff. Yeah, I don't think Riven's gonna file Chapter 11. I don't think they're anywhere near that point. Both March and May had GME below GN before their runs. Well, yeah, because we want to see the market maker net negative gamma. So it's important. Any price target for Rev Opex in case it happens? No. There's a lot of pressure to the upside to keep the price from rising, but a lot of puts sold off on Friday, so we'll see. But definitely no upside target. It's just, I mean, crazy volatile. If the hedge flips, who the fuck knows how high it'll go. See you later, NW. I don't know who that is, Moon Man. Not really. Opinion on closing a position with a high average on a run and waiting for a low price to re-enter versus holding and averaging down. I think that depends on if your thesis is like fundamentally broken or not. You know, people ask me this a lot, but it's situational. You have to learn when it's better to do what, and generally the only way to learn that is practice. That's why I tell people to paper trade. You need to know when, you just need to average down and buy time and wait out your thesis, and you need to know when it's dead and you need to flip. And being able to do that quickly is a really important part of being a trader. There's no easy answer to that question. There's really no answer to that question. It's a per situation basis. All right. Well, I'm going to wrap it up there. Thank you guys all so much for tuning in, and I will see you tomorrow morning. Best of luck to everyone, and I wish you well with your positioning. I'll see you tomorrow. Have a good rest of your weekend, guys.